how this looks in action. All right, so in this example, we are going to look at a trade on GBP AUD, which is a selling opportunity. So it works the exact same way for sells, except you are going to trail your stop loss over highs as the market structure breaks down. The position is just now executed. Our initial stop loss, in order to get us out of a trade in a loss scenario, is above this high. For now, we don't want to move it. We need to see some structure form before we can actually consider moving our stop loss. So we can look at the recently printed low. We need to remember though that until we close underneath this level, there is no validation of this low, okay? The market could realistically move higher. So we don't want to trail stops until the market's pushed under this low. Allowing the market to play forwards, we see we get a nice downward move initially. At this point, still no trailing would take place. Now, one very important thing about this trailing system is that you need to stay time frame relative. That means, for example, in this position we executed here on the 30-minute time frame, we don't really want to go lower than the 30-minute to determine the structure. Because as we discussed before, there is noise on lower time frames. If we execute on the 30-minute and then we go to the 5-minute, there is going to be trends inside of trends taking place right here where I've just drawn this line, which means we may be drawn in, induced to actually move our stop loss into profit or trail it at least behind price based on 5-minute price action. When realistically the market could chop back and hit those stops, okay? Such as just down here, we created this low, we pulled back and then we've pushed back up. If we'd have trailed our stop loss based on low time frame structure, we might be out of this trade, even though it still has all the room to move lower. So now that we've validated and closed beneath this low, we can take the first step to trailing our stop. And that's going to be nice and simple. We are just going to pull it to the entry level, okay? This is now what we call stop loss to break even. That would essentially pull the stop loss all the way to the entry point, meaning if the market reverses on us, we will not take a loss. We will be out for $0, profit $0 loss, okay? I'm going to leave this to visualize the risk reward, but we've pulled the actual simulated trade stop loss down to the entry point. Now we are in a win or no loss scenario. We can also go ahead at the moment and start to look at the low that's just been printed, because if the market was to pull up and validate a high by coming back down and breaking through this low, that would give us what we need to actually trail the stop down to this point, for example. So let's run it forward and see what the market gets up to here. Once again, keeping it relevant to the time frames. So we're going to be working with the 30-minute, okay? So as of right now, basically, as we understand, providing the market stays under this high, it is still in a valid downtrend and we can happily hold the stop where it is without worrying too much about getting stopped out. And if we do get stopped out, it's generally going to be because the market is pushing up and breaking structure, which would invalidate our position. And at that point, we'd rather be out risk-free, okay? So we're seeing the market pulling down, and here we've created a candle closure. Our first break of structure was here, which allowed us to trail the stop to even. Our second break of structure has just taken place here, which would allow us to trail our stop down under the next structural point. That, for me, is going to be this wick area. I'm going to pull this over so it stops being annoying. We could pull the stop to just above this level. It's not too much further, but it gives us at least a small win in the worst case scenario if the market was to flip against us. Now we would like to see, for continuation of this trend, a new high followed by a new low to validate the high, and then we could follow the market down with our stop. So let's see if that happens. We basically just want to see continued downside. Generally, I look at structure as waves. This is something interesting as well. As to not get caught up in every tiny little move that takes place, try to visualize structure as larger waves. So average it out. That's wave 1, that's wave 2, that's wave 3, that's wave 4. This is wave 5. We generally want to see some form of meaningful retracement in order to validate this wave of structure and give us what we want to go lower, okay? So that's the idea of just averaging out the waves of structure so that you can, see them for the full picture. So now that the market's flattened out quite a lot, I'd be interested in seeing this structural low break. We could validate this as a previous structural high if we were to get some solid closures. So there we have a closure. We could go ahead and trail the stop loss down quite aggressively behind price. So now we'd see this as our next structure wave. This is the following one from there. This is where we're actually starting to turn this trade into quite a large one. In the worst case scenario now, we're probably going to get around 2%. Yeah, about 2% if the trade hits stop. But if it continues with the downward trend, we obviously have potential to take this into the full target. So allowing this to run forward a little bit more, we see the market come up. We are looking for a new low. There's our new low. So let's just run through price, remove these off just to keep it neat. We have the first break of structure that we covered, which is going to be this one here. So we created a low and we broke it, which allowed us to bring our stop to here. Then here we created a new low. We broke it here, which allowed us to bring our stop down to this point. Then we created this high, followed by this low, which allowed us to bring our stop to where it currently is. And now, once again, we have created a new break-in structure. So neaten that one up. We've now pushed through this 30-minute low with a nice candle closure. So we can bring our stop down to above this high. We're now probably looking close to 2.5 to 3% return in a worst case scenario. And of course, we can keep running this towards the large target. Let's run it forward a little bit more with our trailed stop. We are hoping that the market will create a new validated low, lower than the previous one, so we don't get stopped out, to keep that trend intact. Okay, so ideally from here, we would see the market start to flip down. We would need to see closures just like that to validate the next low. Okay. Now, this isn't always going to be so smooth, and this is why trailing is a viable thing to do and a very valuable thing to do at that. In this instance, we have had a reasonably nice trending market, but markets aren't always going to go the way you want them to. This one could still flip on us rather aggressively, and that will sometimes happen. That is the whole reason that we do this trailing method, because if the market decides to make a sharp reversal against us, at least we are taking a good profit rather than getting stopped out for zero. So what we can do now is put our stop loss above this high, and then providing the market doesn't make a new high and continues with the trending structure, we should be just fine. Now, there's also another method of trailing that we can discuss in just one moment, around here. Sometimes you're going to be getting very close to your target. So our total target for this simulated trade is 7.7%. We're now at 6.3%. This means we have dynamic risk reward to consider. If the market gets all the way back up here, we'll be closing this trade for 2.6%. That means we're going to be risking close to 4%, okay, 3.7%, just to hold this trade out for around 1% more profit. So we have a dynamic risk reward problem where we're basically going to be risking 3% to make 1. Now, this is the only point of which, if you wanted to, at this point, we could accept, look, this is a very big trade. We've closed 6.4%. We can start to work with aggressive trailing. So remember at the start of the video, I said generally we don't want to just chase price down with the stop. It's a point like this where the dynamic risk reward is worth considering that you may want to do that. Now, there is also nothing wrong with leaving your stop loss where it is here. You could leave this and just let it run. Hopefully it hits the target, and if it flips on you, then you're still going to be taken out for around 2.6%. But if you are a bit more of a risk-averse trader and you are seeing that, look, we've got a 6.3% return here, I would rather lock in as much of this as possible. You could do aggressive trailing, which is essentially where you follow the individual candles down. So if we moved our stop loss to this level, for example, that would mean worst case on this trade now is going to be a 5.9% return, or pretty much a 6% return. You could also, if you wanted to give it a bit more leeway, put it above the previous structural high. So this would be our standard position to put it in. That's going to lock in a 4.6. Or if you wanted to trail aggressively, you could really follow price down. And basically on the formation of every new candle, you would essentially then just follow price through the range, okay? Now in this instance, because of the difference, this is already a 4.6 position. I would say just trailing over the previous structural high is probably going to be the best move here. And if we get a closure down here, then I'm going to get seriously aggressive with trailing the price. But providing the market stays under this high, we should be okay. And because we've now managed to extend the profit potential of this trade out to a minimum of 4.6, I'd be happy to give this little bit of leeway. If we miss out on this 1.5% return, that's fine. We're still closing in 4.6. And if we run straight down, perfect. We can aggressively trail behind price and bring things down to the take profit, okay? So let's see how the market goes. We see a small high being created. Ideally, we would see a push down and closure under the low. That would then validate new lows and we could get really aggressive with the stop trailing. Now, in this instance, of course, if the market reverses on us, we are not hurt here. We've taken 4.6% from a trade. So we're happy either way. Of course, the ideal scenario would be the rundown, but we will just see which way this goes from here. So now that we've started to push down, realistically, we would then ideally want to start aggressively trailing. This is a weekend gap. So this is just an anomaly. Sometimes that's going to happen where you get gaps up. For this trade, we have then been taken out for a 4.6% return. Realistically, we wouldn't be holding this trade over the weekend this close to the target. So it's more likely you'd have taken around 5.5% by closing it before the weekend started. But in a simulation setting, of course, it's easy to miss these little things. So let's take a look at this trade then. Pull this all the way across. We were stopped out just here. This creates a 4.63% return for us. If we take a look at the profits on a $100,000 account, this is a $104,681 balance. So that's a $4,681 profit on that position. Now, if the market was to reverse all the way on us at any point throughout this journey, we've basically built a scenario for ourselves where we are getting out for a win, okay? By the time we got to here, we were already break even. So just this first push removed all risk from the trade. By the time we got to here, we had a minimum of around 0.5% profit locked in. By the time we created this high, we were going to be looking at around 2% profit at a bare minimum. And we've actually managed to follow this all the way down successfully. But had the market flipped on us at any point, we'd have been out for a winning position. So we've created a scenario where it is purely win-win. Now we've been stopped out down here due to a market gap. Your more realistic close for a position is going to be around there. End of week, close the trade up and let it go, which would be 5.87, but even 4.6 is definitely something to be rather happy with as well. And that's a solid explanation of stop loss trailing, which is an excellent way to minimize losses and maximize returns from your trades. Stop loss trailing helps to minimize the risk of losing, helps to lock in profits, and creates win-win scenarios, which is quite a rare thing to get in trading. The simple process to follow that I've outlined for you in this video is once you've entered and your stop loss is under a low or above a high, you would then wait for validation of a new high to form within the existing trend, which requires a break of structure. That low being validated by the creation of a new high will then allow you to move your stop loss up to follow the structure. And again, the formation of a new high will validate the low, and then you can move your stop loss up to follow the structure. And the cycle repeats like this until your target is hit or the market reverses on you, but you still get out with a nice win.